Kenya's Uchumi Supermarkets has reported profit before tax down 21.7% to 403 million shillings as costs rose due to the opening of new stores. Now joining us on the line for a breakdown of the figures is CEO Jonathan Ciano. We seem to have lost that line. Hello, Jonathan, can you hear me?
Yes, I can hear you.
All right, great, Jonathan. Now, looking at those numbers, we saw a full-year profit drop of about 22%. Could you kindly talk us through the reasons behind the fall in the numbers?
Now, I would want to emphasize that we have been going through what I would call the growth path of their company. This is the sixth year that we have recorded profit after the company had gone through what you call a drought season. There were a number of challenges in our region, and this is Kenya, Uganda, and Tanzania. And mainly the euro crisis, the high interest rates, and also we have the prices and the cost of fuels or cost of energy. Those, apart from that, of course, we went and opened new branches, which were being opened during the year, close to the end of the financial year. And of course, we had costs that we had to incur in non-recurring for the purpose of settling into those branches. Those branches' maturity in terms of revenue are expected to come up during this financial year. So that's what you'd call investing for the future years to come.
Indeed, you touched
now,
on
the next thing, of course, is the company had gone for close to 10 years with declaring dividends. And the board has also recommended to the shareholders in the AGM that is going to come for them to approve what you call close to $1 million dividends. I think that would summarize whatever I would have wanted to mention to you. Likewise, I would say the balance sheet has grown by over 23%, mainly related to what I would also term as the prudent way of operations and, of course, the profit or asset growth during the year.
Well, you spoke about opening new stores for this period. Are there plans to perhaps open more stores in the coming financial year, and how are you likely to fund that expansion?
Now, our opening of new branches were mainly in the Uganda region, which was, in fact, we were very dry in terms of outlets. We have only about 2 more that are coming that should be opened during this year, cost of which were incurred during last year. In Kenya, we have 2 more new branches that are coming in. And so during this year, we expect about 4 or 5 of them, but the costs were mainly incurred, substantially incurred in the results that we have already produced. We do not expect the cost growth during this year to be the same magnitude. It was about 19.6% of the revenue, and we normally have our benchmark, which is 16% of net revenue. Therefore, that is something that we expect to recover, and that is going to boost our profits in the coming year. Then, of course, is that maturity of the ones that we opened last year also is going to come in. I think that is, in a nutshell, what I would say, the presentation that I would take to my shareholders in the AGM that is expected to be in the first week of December this year.